I'm Gene Epstein. I was senior economist at the New York Stock Exchange for a number of years. And then in 1992, I got a job at Barron's, Financial Weekly, as actually the commodities editor, because I'd worked in that field and I'd written a book about commodities. And they didn't have an economics editor or columnist at the time. But I started to do articles for Barron's on the economy. And then I got recruited to write a weekly column called Economic Beat, which I then wrote for 26 years. Interestingly, and maybe not surprisingly, when the editor-in-chief said, "You'll write a weekly column on the economy," I thought, well, it's easier to write about the markets. Something's always happening that's new in the stock market or the bond market. But the idea of writing a weekly column about the economy, I balked initially. I avoided him. I thought, well, I don't want this job. I'll just do my articles on the economy on an occasional basis. But then, in fact, I ended up doing it, and I found, of course, there was more than enough to say. And what the interesting history of the markets at that point was that it was just around that time in 92, 93, and 94 that the bond market especially was getting very focused on the economic data. And that the writings, the write-ups of the economic data at the New York Times and elsewhere were getting started because the markets were taking such an interest. The stock market as well, even occasionally, was taking an interest. And I found that one of the ways, of course, to cover the data is to talk to the people who compile the data. Mostly, of course, they are in government. Bureau of Labor Statistics, Bureau of Economic Analysis. It's a bit of a balkanization. Why does the Bureau of Labor Statistics cover the Consumer Price Index? That's because, because it's really always been about labor. In 1913, 1911, the idea of giving labor a cost of living adjustment, and then especially during World War I, became very paramount. So it became the task of the Bureau of Labor Statistics to do the price index. And as I point out to people, in its origins, it was a very left-wing oriented organization, the Bureau of Labor Statistics, and they did everything they could to make the prices look as high as possible. And so I shock people when I say that, in fact, if you do a deep dive into the Consumer Price Index, it actually overstates price inflation. Now, I know once you say that in front of a bunch of even Austrian economists, they think you must be out of your goddamn mind. I mean, the government is obviously understating price inflation. I prefer the Bureau of Economic Analysis, which has a more sophisticated bunch. They're over at the Commerce Department. They do the GDP numbers, and their advisors never quite accepted some of the rigidities in the Bureau of Labor Statistics CPI, and so they have their own personal consumption expenditures deflator that they use. To some degree, it takes a lot of the data from the CPI, but they have a different measure, which is actually, I think, closer to the real rate of inflation, even though that too potentially overstates inflation. So, but that's a long-winded talk about how I began to realize that this data was being misused. One of the most obvious things I guess I should mention is that the markets were constantly treating employment numbers, any number that came out of these statistical mills, as though they had the finality of a market close. And yet these numbers were subject to revision all the time. An initial number of employment is revised several times, sometimes rather drastically. The greatest moment, so to speak, the most ironic moment, was the headlines in the New York Times and Wall Street Journal read, the employment markets grind to a halt. The numbers literally showed zero increase in employment from the non-farm payroll numbers. And at the time, I wrote a column saying, well, this number has sometimes been revised up by 150,000. So all I know is that maybe it was zero, but maybe it was 150,000. Well, several months, and the stock market tanked on the day. Because this was a period of expansion. I'm forgetting the precise year, actually. It was 26 years. But it was a period of expansion, and suddenly zero, grind to a halt. The stock market tanked. And several months later, the number was revised up to an increase of about 110,000. So it was all a ruse, and again, I mean, that was one of the roles I played to try to point out how naively these numbers are compiled. So what I began to learn is that it's difficult to underestimate the naivete with which these numbers are going to be interpreted, including by like Robert Reich, who used to run the Department of Labor, and including the New York Times, and then especially including Paul Krugman, who took over a New York Times column in 1999. Krugman, prior to joining the New York Times, his stuff for Slate wasn't half bad. But then when he had to write a twice-weekly column, he clearly floundered until Bush took over. And then basically whatever Bush did or whatever was happening, you say, you know, Bush is terrible, the economy is going to hell. And so he tripped over himself all the time, screwing up the numbers, misinterpreting what was going on. Could never make a phone call to the Bureau of Labor Statistics. What you find is when you call these bureaucrats, a lot of them are PhDs, very smart people, but they have a lot of time in their hands, so they don't mind schmoozing with you. And in addition, they often have a lot of sophistication about what they do. You know, they just wanted to sign on for an easy job, and they can give you insights into their numbers because the government websites, as you might imagine, are not very good. Well, I started my long-winded talk, but use and abuse of data is what I'm calling it. But now the next slide, please. So I published a book in 2006 called Econo Spinning, How to Read Between the Lines When the Media Manipulate the Numbers. That was a title, by the way, given to me by my publisher. And predictably enough, the first 5 chapters were about Paul Krugman. In that book, because as I said in interviews, you can't possibly do such a book without giving Krugman a fair amount of space. And specifically, I focused on the things that he kept saying over and over again. Nothing that he said that was just a one-moment gaffe, just the kind of stuff he kept repeating over and over again. When I was accused of being a right-winger, I kept pointing out to people that I also had a chapter in that book called Bush League Economics, and that was an attack on the Wall Street Journal. And I said, you think I'm a raging right-winger. I work for Dow Jones. Dow Jones' flagship publication is the Wall Street Journal. I'm attacking my own sister publication for their right-wing bullshit about the employment numbers because they wanted to see Bush reelected. Am I really such a right-winger as a result? I actually, years later, by the way, I read, there was somebody from the Wall Street Journal who tried to get me fired because I published a book review. That was Brett Stevens, by the way. Tried to get me fired from Barron's because I published a book review attacking one of his books on foreign policy. And he thought that to publish a critical review of his book on foreign policy, since he was right upstairs at the Wall Street Journal, was a breach of journalistic ethics, according to him. And I said, well, I wrote back saying, we'll give you a whole page, your ability to respond, give you a whole page in mailbag if you want to respond. I was at that time running a debate society. He said, I'll sponsor a debate between you and the author of the review. And Brett wrote me back, I cost $30,000 to appear. That was a little bit outside my financial range at the time, so I couldn't have him appear. And he disdained the idea of responding to the review in mailbag. He just wanted me fired for what I had done. And then happily he moved over to the New York Times, which is where he's been flourishing ever since. So he left, and so he was no longer there to harass me. But I'm getting too embroiled in my own memoir, and as I often do. So the next slide is this. That's my Twitter handle where much of this is published, and that's my email address. So for you guys, obviously this is going to be a superficial look at things. We're going to have some Q&A, but if you have questions or anything else that comes up, you can write me on the Twitter, or you can write me for a longer form answer on Gmail. Even though since Naomi is here, I'm going to be switching my Gmail very soon to Proton, but right now. But right now, it's a transition. So that's what I'm doing. So please don't walk out, Naomi, in disgust. Okay. So all right. So then, okay, next slide. Okay. All right. So now I'm starting with a little bit of the substance of which you came for, the substance of the morning. So this is from the Wall Street Journal. Spring spending surge pushes growth despite rate rises. Consumer purchases account for 2/3 of U.S. economic output. Okay, so they look at consumer spending, and really that's really all they ever report on, sort of up or down. But although I chose sort of a bad example because it was up, but even so, wherever it goes, they constantly repeat this metaphorical statement that consumer purchases account for 2/3 of U.S. economic output. Now we know that in fact. I mean, that's, again, a naive way of putting it, and this is the Wall Street Journal, because obviously gross domestic product is just a measure. A measure that actually I have somewhat more respect for than most of my Austrian colleagues who think it's total bullshit. I do have some respect for it. I will say that any alternative measure that anybody comes up with pretty much correlates with the GDP number anyway. You can also, by the way, easily calculate a private sector GDP. You can take out government, which I admit is a bit of a, government, invests more in bombs that kill people. So of course the GDP goes up. But the private sector GDP pretty much correlates anyway. But the point though is that to talk about economic output rather than just gross domestic product, and of course if you say that, then eyes will glaze over and it will look like you're some kind of quant who can't speak the language of the masses. So you say economic output, but really what is it? It's that personal consumption expenditures, which is that have been about 65% of GDP. That's true, okay. But obviously, gross domestic product is just one way of measuring economic output. There are many other ways, and of course, most of where we work, most of what we do is not in the consumer goods, it's not in retail, it's not in those things that sell, that account for that 65% of GDP. Most of what the rest of us do is in B2B. The 2/3 of the economy really is B2B, but it is true that gross domestic product thinks that it would be double counting to count, or the typical thing, of course, is to use my preferred thing, since I'm an old-fashioned guy. The farmer grows the wheat, then there's a direct, sells the wheat to the miller who turns it into flour. The flour guy sells it to the bread factory, turns it into bread, and then it's shipped. So there are lots of transactions, and that's where most people are working. But of course, if we net that out, then the bread purchases become 65% of GDP. So that's why it's obviously a distortion. On the other hand, I would more or less defend the idea that we only count the purchase of the bread because it obviously incorporates all those other transactions from farm to from the wheat to the miller to the bread baker. But that's why you're going to encounter this all the time in what you read, and it's naive. But then this is the key thing that is interesting to note, which I'm going to show you in a moment. We Austrians will say, as indeed I count myself an Austrian, we will say that really the investment markets are what brings the bust, certainly. And even though in GDP, 65% is personal consumption and gross private domestic investment, which I will recount to you. It's all anything really that's investment for the future, including housing. And it does include the building of housing is actually, of course, the basic concept of is really what is being produced for consumption over the next 12 months. What's being produced mainly for consumption, starting 2, 3, 4, and 5, and 10 years from now. That's housing. Of course, that's plant and equipment, and that's software. That's intellectual property, and it's also inventories. If you're building inventories, so it's a big number, so to speak. But it's only 18% of GDP versus 65%. That's true. But interestingly enough, even the GDP numbers, now let me show you this next chart. Now, hopefully we can see what is being revealed here. My point is that even in terms of the GDP numbers, investment takes more from GDP in downturns. Okay, now, the Bureau of Economic Analysis will give you numbers which say GDP was up 3%. And then they will give you a complete itemization, they're nice quants, give you a complete itemization, how much of that was accounted for by the movement in consumption, and how much of that was accounted for by the movement in inventories, how much by investment. A complete itemization, and of course, some of it will be detracting from that 3%, some will be contributing, and it will all net out to that 3%. And so what I've done there, and hopefully you can see it clearly enough, is I've taken the contribution, that's the movement of consumption, personal consumption expenditures to real GDP, the percentage change, and that's the red line. Now, notice, and then the blue line is gross private domestic investment, which is only 18%, and you can see that even though it's only 18%, its fluctuations rival, just for starters, they rival the fluctuations in personal consumption. Although admittedly, for most of the time, every once in a while you see the blue line, the investment line, exceeding the red line on the upside. But most crucially, the blue line exceeds the red line on the downside in almost every case, with the exception of the slightly crazy, you see, in the end, the slightly crazy 2020 recession brought about by the Great Suppression. Only recently was there an exception that the consumption tanked even more than the investment. In other words, that's the extent to which the collapse in GDP is being accounted for by investment. And so I'm able to show even mainstreamers as something more subtle, which maybe this graph doesn't quite show, which is that what you really have to look for about what's falling, if there's anything signaling an imminent recession, it's really that the contribution of investment starts to fall. Consumer spending falls, but usually, almost always, once the recession has begun, those are the gray bars, I should have told you. Those are the gray bars. And of course, my point is that even the conventional GDP numbers tell an Austrian story that really it's investment that's collapsing, and that's what's collapsing first. And then, of course, workers are laid off as a result, and then consumer spending falls. Never as much as investment falls. However, investment is always really the thing that's tanking. So what's my lesson there? My lesson there would be to these Wall Street Journal guys, and actually most lately, since I've been on Twitter a lot, I sometimes do communicate with them more than ever, and I try to tell them, look, you don't have to resort to rather arcane numbers. Just look at the official figures and you'll quit focusing endlessly on that personal consumption expenditures number. Because especially now that we're looking at the risk of recession, especially now, you want to see that historically the first thing that starts to drag it down is investment. I was asked by a colleague, well, it's such a small percent of GDP. What are you talking about? Well, I could show you other measures showing how volatile it is, but this is the bottom line. So that's one of the main lessons I try to teach the mainstream coverage. And again, the New York Times, of course, is 5 times worse than the Wall Street Journal, but the Wall Street Journal reporter, as I just showed you, they're capable of the same mantra: consumer spending, 2/3 of the economy, constant refrain, as though consumer spending is the real story. Obviously, we know that consumer spending clearly doesn't matter very much in the long term. I'm pointing out doesn't matter very much in the short term. So let me show a couple of more slides, and then we'll have an intermission. All right, I guess this is another subtle story, because it has to do with the recent flutter on Twitter, certainly, and in articles. This is from Business Insider. And the broad dispute has to do with this somewhat crazy idea that corporations are causing the price inflation. Okay? Corporations are causing it. And of course, we Austrians might say, or even the monitors might say, well, that's shooting the messenger. They're charging higher prices, and for that reason they're causing it. But then there's a focus on profit margins. Focus on profit margins in order to supposedly prove this point. And I'm going to get into a subtlety about it, and I constantly tweet about it because it's constantly coming up. This is from Business Insider, and this is the chart. So let's walk through it. Corporate profit margins, which measure how much money a firm makes from sales after factoring in its expenses, more or less okay, also began soaring in the second quarter of 2020, and hit their highest level since 1950. The real monster behind soaring prices, it's becoming clear that corporate greed is screwing over the US economy. BusinessInsider.com, May 2nd, 2023. And this was actually drawn from a study that was done by 2 economists at the University of Massachusetts about this chart, about profit margins, and so on. And what it purports to show, you can see that profit margins are recently at a peak, bouncing around on a quarterly basis, but then look back and they point out, well, that early period of 1949, 1950 was actually a period of a surge in price inflation. And so they say, there you got it. Our profit margins are soaring now. We've got a spike in price inflation, and then you had a spike in price inflation, and profit margins were soaring then. Although, of course, if you really got into the weeds, you'd wonder why the hell were profit margins when in the 1970s and into the early 80s. Not many of you are too young to remember that price inflation was hitting double digits then, and yet profit margins seemed like they were in the toilet at the time. But okay, but that's carping. The only point they're trying to make is at least they got some kind of snapshot, which is that profit margins were soaring in 1950, and they're soaring now. And first of all, that's pretty ugly, isn't it? That corporations are doing so well in the price inflation with the profit margin. And secondly, doesn't that really suggest that the correlation must be causal? We could get into those subtleties, but the real point is that what you see at the bottom, which actually probably is too small for you to read, that this is, the chart shows after-tax corporate profits as a share of non-financial corporate sector gross value added. After-tax corporate profits. Well, of course, this is something that the progressives would also regard as ugly. As you probably know, as many progressives seem to know if they listen to Robert Reich, the corporate profits are being taxed at a much lower rate now than they were at that time. And now I then took the same exact numbers in the chart you're about to see, but I took pre-tax corporate profits. So let's take the next chart, pre-tax corporate profits. Okay. So that's the same exact chart, but which I reproduced from my Haver data, and it's pre-tax corporate profits, the same non-financial corporate sector, same share of what they did, of the gross value added, which has a problem or two anyway. But that's what the pre-tax pattern looks like. So I guess now, obviously, then what we're really looking at most recently is we have a profit margin now. Most recently, you see that red line that I drew, the most recent quarter, which was the second quarter of this year. It's actually somewhat lower than it was in 05, 06 when price inflation was tame, and it's basically much lower than the 1950s and 60s into the 60s. When that period when there was a spike in price inflation, the real pre-tax profits were much higher. So the pattern then is totally different once you take pre-tax corporate profits. And again, this only involves a conceptual leap. Isn't the bottom line, what are they making on a pre-tax basis? Whatever is being taken out in taxes comes later. Isn't it obvious that whoever compiled that after-tax chart and left out the pre-tax picture is clearly probably knows what she is doing, because there actually was a couple of women who did this research, and they probably know what they're doing, what they're pulling. I guess they tell themselves that pre-tax profits don't mean, but obviously pre-tax profits are where the rubber meets the road. This is where it's at. And now this is the funny part, which I get into in many other charts. The embarrassing thing about this chart, as well as related charts, is that the period of the 1950s is supposed to have been the glory days of progressivism, when unions were strong, when there was little to wear price competition, when things were really growing and workers were treated well, and all they asked was a return to the glory days of the 1950s. Well, profit margins were higher in the 1950s than they are today. You know, the corporations aren't exactly in the saddle compared to today. So again, all I try to point out is you can get into the weeds of their analysis, but the point is that if you just look at the real point about pre-tax profits, then the story just melts away anyway without getting into any of the other aspects of the argument. I mean, other aspects of the argument would be to say, well, let's say we shaved the profit margin by a bit. What share of consumer spending could that possibly account for? Practically none, nothing. And so it clearly has very little to, the profits picture has little to do with the price index picture anyway. So what I wanted to do was break it up into intermissions, and if anybody has a comment or question now, then I invite it. We could pause and I could go over some more material. Anybody want to mention anything or ask a question or whatever? Or we can, yeah, go ahead. Give him the mic. Yes, Frank, yeah. Yeah. Look, talk into the mic, Frank. This is being recorded for posterity. I didn't tell you guys. You haven't signed releases. Whatever you say will be used against you. Go ahead. Yeah.
So I'm just wondering then if the difference between the pre-tax and post-tax graph, then is the argument that, okay, they're making money because tax rate is lower today?
Well, they're after taxes. They're doing better. Yes, indeed. Yes. Yeah.
The progressives use this to argue we should raise taxes?
Well. Actually, I'm going to get to that aspect of things. They're anticipating something for sure. Although anticipating your question, I'm going to point out that actually the top 1% is paying a higher, at least compared to the figures we have, a very high effective tax rate. Bear in mind that when corporations bring in their profits, they go for dividends, they go for investment, they get taxed as dividends, they get taxed as wages, they get taxed as capital gains. So bear in mind that it isn't as though that money doesn't escape taxation, and it isn't as though the 1% doesn't have to pay a lot of taxes on a lot of that money. When they earn their capital gains, they pay. When they earn their dividends, they pay taxes. When they get their bonds. So therefore, that's the next part of it. But you anticipate something right when you say, well, okay, you made your point about the pattern of profits, but look at this outrageous fact that even though their pre-tax profits ain't great, their after-tax profits are terrific. You're right. That's the point. But however, the response there is, well, corporations don't pay taxes. Only people pay taxes. So the next question is, what taxes are people paying? If you care a lot about progressivity, you'll be happy to learn that based on the available numbers, the rich seem to be paying more in taxes than ever before. Even though, by the way, Frank, I don't have good numbers going back to the 1950s, but all the numbers since the 1970s indicate that the rich are paying more in taxes. But hopefully I've answered your question. Yes, it opens up that question, and there is an answer to it. But again, corporations don't pay taxes, only people do. Any other comments? Okay.
You mentioned that.
Yeah.
You mentioned that when the employment numbers came out, or the one statistic that came out was wrong, and then it was revised. But when it was wrong and it came out, there was
The stock market tanked, yeah.
Is there a corresponding spike when the revision comes out?
No, yeah, thank you for that question, because I should have added it. Of course, it's barely noticed. You know, they don't notice it. Because the markets are just intent on the new number, the fresh number that comes out. The media pounces on it. A number from 3 months ago, they don't care. That's as old as yesterday's news. So indeed. That's a good question. It was not even reported on, not noticed. The market commentators didn't notice it. It's just blended in with the past. Absolutely. That's the basic problem with how ridiculous it is in the way that the markets follow the numbers. Yeah.
Quick follow-up question: is there a business opportunity for a hedge fund that exploits the?
Well, yeah. It's a good question. But obviously. Obviously I'm not, of course, my usual greedy tendency, I started to think about that, but your question. But bear in mind that I was unable to answer, I was unable to predict myself that it would end up being 100,000 plus. I'd only said that it's premature. The zero move is just so dramatic that it's clearly scaring people. It could be as high as 100,000, but it could have been confirmed, you see. So therefore, it would have been a risky bet. But with that said, I imagine that some kind of brilliant quant might be able. By the way, what's interesting is that the Bureau of Labor Statistics publishes all the, what's it called? It has to do with, they talk about wine. It's an analogy they use with wine. Having to do with they have a complete history on all of the initial estimates and then the revisions. You can dig up all of that data. Vintages. They call it vintages. The vintage data having to do with what was initially reported. In other words, the other naivete about what a lot of economists do and econometricians is that they only look at the data that's now officially published, and it's all been revised. There are like 6 revisions that occur for different reasons, having to do with seasonal adjustment, for example. So therefore, they're not really looking often at the numbers that were published at that time. But the vintage data is available. So I invite you to give me a call once you've figured it out, and we can make a fortune from it. Okay. Anyway, so I guess no other questions. Let me proceed. Yeah. Oh, yeah. Well, okay, in that case, just to gild the lily, I guess, what did I do? Oh, yeah, before, yeah. The interesting point about, just to hit home on the corporate profits point, is that what was interesting is that that's corporate profits before tax, same numbers, all complete corporate profits. That includes financial firms also, non-financial and financial, and only showed that what's interesting is that the nominal numbers on corporate profits peaked in second quarter of 2022, and have actually been declining in nominal terms, even as prices have increased. So that would be another killer point about, the nominal figures are declining, so, and prices are still going up. Anyway, let's go to the next slide. Okay. So the point is, since I raised the issue of inflation, and I will say, for example, that I don't know if anybody reads Greg Ip of the Wall Street Journal. He writes a column called Capital Account, and I've known him for many years. He used to cover the stock market, and now he went to The Economist, the most overrated weekly in the world, and then he moved to the Wall Street Journal. And I've sometimes, because he knew me when I was at Barron's, most of the time when I jibe him, he answers me. But I don't think I can teach him anything. He recently said, he had written that he thinks that in this price inflation, the role of money doesn't really matter. Doesn't matter. And so I wrote him, and I sent him something like this chart, although, of course, it was not as recent as this. But so what's this chart show? Just the stock of money. That's M2. M2 is the most conventional measure of money, and this is the 24-month change, rolling 24-month change. And all it purports to show is that here we had two spikes in the 70s, and not coincidentally, we had double-digit inflation in the 70s. So then we have a much lower trend subsiding, and then we have this off-the-chart spike most recently. So basically, that's what I sent Greg Ip. And he predictably gets defensive no matter what. He then started to tell me that this would be of no use in an econometric model, because there's only two data points. It's no use in an econometric model. So it doesn't matter that it seems to connect with these two periods of price inflation. It's highly suggestive. On top of everything else, of course, most crucially, the idea that it's a monetary phenomenon, the idea that there's more money and consequently prices will rise, one would think it would be an intuition that would drive the causal analysis. But that meant nothing to Greg. All he wanted to tell me was that, I was clearly just an old fart out to lunch. Econometrics couldn't handle this. And of course, if econometrics can't handle it, then we can't handle it at all. It has nothing to do with determining the truth. So I just wrote him, I was in one of my more polite modes, and I wrote him, Greg, I'm not trying to build an econometric model. I don't know, I guess I'm not good enough to do that. I've never built one. I've commented on them, but never built one. But look, the monetary factors seem to matter, And I could have insulted him and said, Greg, you got your head up in the clouds. You seem to think that the data have to suit the model rather than the model suiting the data. Rather than the causal analysis driving the model, it's just a matter of what the model. It's only like a couple of data points, but it's just suggestive enough to indicate what happened given the power of the causal analysis. So the point that what's interesting, by the way, is just to complete the story, is that we are now down to a 2.7% 24-month increase. We're down negative for 12 months. So, and that's alarmed a people, then bear in mind that, so I drew this red line at 2.77%, and we were actually somewhat lower in the mid-90s. So all I've said to people is that this is an April number, some latest number, that if you want to get disturbed from this monetarist standpoint about what's going on in the economy, I want to wait for the 24-month to be negative, because the spike recently was so great that we really have to decline in order for a 24-month spike to be down. I mean, if I gave you a 12-month, you'd see a negative figure. But the 24 months seems decent enough, and it does show that that the money supply is still higher than it was 24 months ago. And now, of course, that's a little bit of mysticism. It does have to do with Milton Friedman's idea that the money supply has to keep increasing. So to some degree, I play the Chicago monetarist game. But certainly, this M2 was compiled by the monetarists. But just a similar point, the Mises Institute has their own definition of money, and they keep posting their chart. But the recent data that they compile, I guess it goes back 30 years. Can we get the slide back? Yeah, gotcha. The recent data that the Mises people produce correlates very closely, but with M2 anyway. And then with M2 we have a much longer series. And why quibble with the official data if the alternative measure you compile doesn't veer very much from the official measure anyway? Why provoke that argument about how to measure it if M2 is what all the monetarists respect and all the textbooks respect anyway? So that's the M2 story. So my only point is that, well, it wasn't profits. It looks as though it was money. If there's more money chasing goods, the prices will rise. But then, next slide. Yeah, so then the other part of the story, I don't get this from my Haver data, but it comes from, this is the database that everybody uses, FRED, Federal Reserve Economic Data, affectionately known as FRED, released by the St. Louis Federal Reserve in charts that are actually rather sloppy, but most of the time when you counter these charts, they're using FRED. I get Haver data, and then they're nice enough to give it to me for free, which is quite a boon, because I used it for 26 years at Barron's, and I promoted them at Barron's, so they've given me a grandfather clause, and I get their user-friendly data. But I had to use FRED in this case. The only point is that this is the central bank holdings of treasuries via printed money. So the holdings of treasuries, as you can see more or less on the chart, in February 22, it was just right before that recession, and then it leaped up and it peaked at it more than doubled. Trillions of extra bonds bought by the Federal Reserve, and of course, that's their holdings. Bear in mind, when the magic of holding bonds is that, including if you're the Fed and you hold bonds, a lot of the bonds you're holding are always maturing. So if you don't buy any more bonds, your holdings are going to decline. And in fact, interestingly enough, they slowed down their purchases. I mean, the Fed has really done that. Slowed down their purchases, and so actually the holdings are beginning to decline, as you can see from that line. But my only point is that the 3.5 trillion jump, which is obviously off the charts, meant they did it with printed money. They created the money. It went into M2. So the brief story you can tell in two charts is that the Treasury decided it needed to borrow trillions of dollars. It wasn't going to sell it to the market. They just called up the Fed and they said, would you please take a few trillion extra? And the money was printed. The treasuries were bought. The money went into the banking system. It spiked M2, and that's the story. It was the Fed created inflation, and as I say, they had to have bought more than 3.5. What we have is their holdings. Maybe this figures on purchases. I don't find them directly on FRED. Their holdings went up by 3.5 trillion, even while a lot of their bond holdings were maturing. So they bought probably 4 trillion, 5 trillion over this period, because this is a net figure. So again, that's the story of inflation in two charts. And a story that eludes people that it was the Fed. It's a very simple story. And again, part of my lesson is a lot can be learned by tracking and being familiar with government-released numbers. What's the next here? Okay. Well, actually, in this case, I guess I'm kissing the asses of the ruling classes. I'm pointing out that I have to admit I am somewhat impressed by Chairman Jerome Powell's resolution to finally do something about price inflation. This is a simple thumbnail sketch, very unsophisticated. It only shows what the PCE, chain price index, as I mentioned. I don't use the CPI. I use the personal consumption expenditure deflator, by the way, is a continuous series. The CPI is discontinuous. It's very distorted. They keep revising it, but they don't retrofit the revisions to the official numbers. They don't do that because there'd be lawsuits between spouses because alimony payments and union payments are fixed to the CPI. So if they kept revising it historically, then there'd be revised contracts. So the PCE is better, it's more accurate, but this is the 12-month change that's the blue line. That's just the 12-month. And so all it really shows is that for the history of the Fed, the Fed funds rate target, the official overnight interest rate that they keep talking about, was pretty consistently, with some little lapses in the 70s, but the red line was pretty consistently running ahead of the 12-month price inflation. And really, here I'm trying to tell the conventional story, which is that if I were talking to the Fed, you've had a 40-year history up through the early 2000s of maintaining a Fed funds rate that's above the 12-month rate of price inflation. Why are you suddenly repudiating that policy? Because then you suddenly find, if you look at the red line, especially starting in 10, we have a price inflation rate that's much higher. We're at 0. What is the sense of repudiating that simple history? Why is it running lower than the rate of price inflation? Then when it was always running higher, wasn't there some and isn't it logical that any interest rate should be higher than the rate of price inflation? Because who in his right mind would lend at an interest rate that's below at least the expected rate? Obviously, this is a slipshod because I'm not looking at expected rates. There are figures on that. I was just trying to deal with something that's fairly simple. And but then what's interesting is that for the first time, pretty much briefly it was down, and now we're at we're now at 5%. Fed funds rate, and the rate of price inflation is at a little over 4%. For the first time now, Powell has pushed it up above the price inflation rate. I do think that, I guess contrary, maybe we could get into a dispute in that regard, contrary to what's thought, certainly I do think that at least for the short run, clearly, the remedy of keeping interest rates above the rate of price inflation, which he's done, was a remedy. Price inflation has slowed. His resolution to do that, at least up to now, it's been easier because we haven't had a recession yet, which of course is a big puzzle, but still, he's done it. He's followed through on his resolution, and so in that way, I'm pandering to power. I'm admitting that he did the classic thing, and I think the classic thing does make a certain amount of sense, even though obviously it's all the real underlying problem. Of course, is the soaring debt. The soaring debt means that the Fed will have to come in at least some point and many points to monetize that debt continuously, so the long-term problem is not going away. Monetize that debt and create money. So I think did you want to have a question, Matt? Yeah.
You say that we haven't had a recession.
Yeah.
What is the definition of a recession? Because it definitely feels like a recession in certain sectors of the economy.
Well, Samuelson's joke. This is the second joke of Samuelson that I use. A recession is when your neighbor is out of work. A depression is when you are. And I guess a recession is when this man's friends are out of work. And a recession is when my friends are out of work. But no, the only point I would say is that as you probably know, the Business Cycle Dating Committee, I could tell you a great inside story about how corrupt they are and how, because I heard it secondhand, although it was from such a good source that they dated the recession of 2001 because there was the Democrats on the Democrats versus the Republicans. The Democrats wanted to embarrass George W. Bush. The Republicans wanted to embarrass Clinton, and the Democrats prevailed. I mean, it was all over politics as to when you date the beginning of the. But as usual, I'm not answering your question. The only point is that I do feel that if I look at all of the official numbers, I believe in statistical redundancy. All of these numbers, they weren't compiled by Austrians. All of these numbers are really the blind man goosing up the elephant. Is it a trunk? Is it a, we're really just groping for a look at the broad economy. And the grope means that you want statistical redundancy, which means that you at least want to feel that many of the independent measures you're looking at, independently derived, more or less line up. And I can only say that if I listed employment, the private sector, look at services and manufacturing, the stock market to some extent, the GDP numbers, the private sector GDP, all of those numbers indicate that when I compare them with the way they looked during official recessions, we're not in a recession. On the other hand, there are always, I guess, as I think this gentleman on the couch would say, it looks as though the tech sector is in a recession. There can be sectors that are on their ass, but then of course there will always be, in a healthy free market economy without the Federal Reserve screwing things up, there will always be sectors that are suffering. But when one sector suffers, other sectors will often benefit because they'll get the workers, some of the shortages. There's always reassortment. There's, by the way, do you know, I mean, another final thing, do you know that when the press says 200,000 jobs were created last month, what they really mean is 1 million jobs are destroyed every month in the U.S. economy from bankruptcies. So again, my brief answer to the question, and unfortunately you'll have to throttle me later because we have 30 seconds to go, is that based upon the whole range of figures from private sector numbers, from the ISM on services, employment numbers, GDP numbers, all independently derived, all of those numbers were flashing recessions in the past and aren't flashing it right now. Right now, as I insist, we are suffering from stagflation, meaning that we're barely crawling along, barely any growth in the economy at all, a tiny bit of growth here and there, but basically almost flat, not collapsing, but flat output, flat performance. With 4%, 4.5% price inflation, we have stagflation, but then that's of course stagnation, but it's not a recession. Anyway, thanks very much. And again, if you noted down my email address and my Twitter handle, if you write me an email address and you follow me on Twitter, you have questions, you're a select audience, you're my pals from Porkfest, and I'll give you a special response. Thanks again. Sure.